Welcome to yet another episode of MH Consultants Breakfast Banter. This is me, Anita, and this is my co-host, Ron Howard.
Thank
and
you.
together we form MH Consultants. And on our podcast today, we're going to talk about something that's coming from our previous season, right?
Yeah, this is a follow-up from a previous episode where we were asked by a listener to recommend investments that a salaried employee could make without taking on too much risk.
And that particular episode was very well received, and we understood that a lot of our audience is actually very interested to understand how they can invest risk-free or
Never any risk-free
no, it's nothing is risk-free.
Never,
with minimal risk.
Never. Huh?
Minimal risk?
Yeah.
Yeah.
Minimum risk.
That would also include me, Ron.
I'm doing the podcast then for you?
Yes, also.
Okay. But that was a subject that covered a lot, wasn't it? Stocks, property, futures trading, commodities and crypto. For this season, we've split those subjects into 3 separate episodes. This one on stocks, one on property and one on the others. We also hope to welcome an expert on cryptocurrency as a guest.
Yes, very soon. That's lined up as well for season 3.
Because I know you're so happy to be wanting to invest in crypto.
Yes, I mean, I'm interested. I'm open. I'm curious about it.
It might be the right time to get in.
Yes.
Who knows?
Okay.
But I think it's fair to say, and should say at this point, that we are not licensed professional advisors, and we're not attempting to sell any products. We are instead highlighting some practical points about investing in stocks for that salaried employee who wants the maximum return for the minimum risk.
Yes, absolutely.
So usually at this point, again, I start and say, what's for breakfast, Anita? Pretty minimal today, I have to say. I've only got a cup of milk.
You're skipping breakfast, Ron.
It's not the biggest breakfast, is it?
To save to invest.
I think I must have overeaten last night, so I'm just having milk today. Right, okay. So here's a question for Anita straight away. When you're investing, what part of investing can you actually control?
I think there are a couple of parts that I can control.
Yeah, okay.
One is how much money I have
How
to
much
invest.
money you invest?
Yes.
Yeah.
What are the stocks that I want to invest in? I can select them.
Yes, you can do that, yes.
Based on research.
Yes.
I can also decide what is the loss I can take.
Your loss appetite.
Yes, and so that's risk appetite too, right?
Yeah, risk appetite, yeah.
And how much fees I should pay to whoever is helping me through?
The fees, yes,
Yeah.
the fees. If you're going to use an advisor or go into a fund. And of course the timing. Timing is important.
Yes, absolutely. That's important too.
So I have to read this bit because it's pretty complicated, deliberately complicated.
Okay.
So maybe, for example, by performing research on companies to invest in, understanding how to calculate the value of those companies, judging the present value of their future cash flows, and from that choosing companies to make a diversified portfolio which reduces non-systematic risk, you might be successful. Did you understand much of that?
The only part that you need to understand the valuation of different companies.
Yeah.
That's it.
That's right. It was a complicated sentence,
Yes.
and it wasn't meant to be, because that's what professional stock pickers will do for you.
Okay.
They will do all of that, and you pay for it. Do you get better results?
Definitely, I'm sure.
Well, that's good answer. Remember that answer. Remember that answer.
Okay.
So you could do that, and a lot of people do, and expatriates here, maybe not just expatriates, Bahrainis as well, have probably been approached every now and then by advisors who want you to invest for several years, and they will use that money to invest, and they will take professional fees off you.
Yes.
So you can do that. No problem with that. There's a whole industry out there doing it. Or another way is you could follow the financial media and buy a stock in a company that is reporting good results. I can give you a few very recent examples. BP, I'm sure you've heard of BP, British Petroleum.
Yes.
Reported record profits in the last few weeks and a massive share buyback. The shares rose over 7% in one day, so you might not have got into it by then, but I bought the following day because the demand was strong for the next few days. Stocks went up, you're in for a few days, you make money.
Mm-hmm.
Meta, that used to be Facebook,
yes,
they also reported good results and their shares rocketed 20% in one day.
Mm-hmm.
Now, you could have bought it before, but you don't know what the results are going to be.
Right.
So I bought Meta again after the first day and made quite a good profit on it.
But is it still going strong, Meta?
As in the company or the share price?
The share price. Because
I was out after 3 days.
Ah, okay. So it's just a
on the other side, Standard Chartered, there was a rumour that a bank in Abu Dhabi was going to buy them. Stocks went up again, I bought them, and then Abu Dhabi Bank said, well, actually, we're not going to. So the price went down and I lost. But it can be a good way for people to buy or make money on it. But does the salaried employee with a family to go to at home really have time to follow the financial media? Maybe.
Maybe not.
Or maybe not.
Mm.
It's something to look at. You know, if you're interested in reading financial media, you can get profits on the back of a big move because the tide is still moving in the same way, in the right way. Anyway, that's one way, so there's a good way for you. Now, last time we talked about the option of tracker funds, and when you talk about a diversified portfolio, it means a number of stocks in different industries, different sizes of stocks. I could go into betas. Some of them move higher or more than the market, and you diversify them to reduce the overall risk. Well, nothing is more diversified than a tracker fund. If you're getting a tracker fund in the S&P 500, you've got all 500 companies. And I'm sorry if I usually talk about American or British stocks or stock exchanges, but it's the same for India and Bahrain, etc. So we'll talk about them in more detail. Now, according to the Financial Conduct Authority, that's in UK, tracker funds replicate the holdings and performance of an index or a sector. So the index goes up 10%, your fund will go up a little less than 10% because you've got some fees. But similarly, if it goes down 10%, you're going to go down 10%. So that means your profit or loss will be almost the same percentage as the market profit or loss. In 2022, the top 100 UK stocks, or what we call the FTSE 100, increased nearly 5%. So if you're in a tracker fund, you'd get somewhere near 5%. The Indian Sensex, I've brought in India here, by nearly 6%. But the Dow Jones in the US dropped nearly 7%. So you're looking at a loss there. Clearly not a good result for the Dow, but remember, an armchair investor should be looking for medium to long-term loans. So we're looking at average there. We're not just always looking at 1 year if you're a medium-term investor. In 2022, the top UK 100 stocks, or FTSE 100 as it's called, increased nearly 5%. That's not bad when you're not doing anything, is it, to get 5%? The Indian Sensex, I brought in India, I should have done Bahrain as well. I'm sorry. By nearly 6%, but the Dow Jones in the US dropped nearly 7%. Clearly not a good result for the Dow. But remember here, we're giving advice to an armchair investor who is looking for long-term, even medium-term gains, not just 1 year. In fact, the Dow has given average profits of 10% each year over the last 10 years.
Right.
So if 1 year is down, overall it's been up by 10% a year. I think that's a very good result when you're not doing very much.
Sure.
So is 10% a year sufficient for you, Miss Salaried employee who doesn't want much risk?
Yes, why not? Sounds good.
Yeah. So one of the areas you mentioned that you have a choice is what fees you're willing to pay. If you use a fund manager that you just told me before as a professional and you think they'll do a lot better than a tracker fund, this fund manager will pick your investments and you're likely to pay between 1% and 5% in fees every year.
And what about the returns? Do they have a better
They
track
don't
record
have
of
it.
returns?
Well, I'm going wait and see.
Okay.
Compare this to an average of 0.06% to 1% for tracker funds. Much, much lower. So I'll give you some perspective on that. So these figures are from my favourite newspaper or media, the Financial Times. If you invest £100,000, or it can be other currency, 100,000, for 30 years, you've got 100. I know that's a long period. I'll shorten it, but 30 years. That £100,000 invested for 30 years. It's gaining 5% a year. So the fees, if the fees are 3% per annum, you're going to end up after 30 years with £190,000.
That's the fee we pay out.
If you, well, I think you like this better. If your fees are 0.5%, you're going to end up with £380,000, double.
Okay.
The portfolio or has recorded the same profits over the period. The only difference is that the fees have been taken out. And between 3% annually and 0.5% annually, you've actually doubled what you've got at the end of 30 years.
So what is an equivalent of a tracker fund
Equivalent?
to, let's say, in India or Bahrain?
I don't know. You'd have to find that one out. Anita will find out what the equivalent of a tracker fund is in India. So should I give you an example of a smaller investment? Because not every, I guess a portfolio of 100,000 rupees is not a lot, is it? But
No.
£100,000 is quite a lot.
Yeah.
So £10,000. So you invest £10,000 growing at 5% a year over 20 years. If your annual fee is 0.1%, that is worth £26,000 after 20 years. If there's a 1% annual fee instead, it's worth £22,000. So I think there that I've managed to show that the lower the fee, the higher your return will be if you're getting the same returns, you know, what I mean
consistently.
yes, because I've still got to answer your question about whether these actively managed funds using a professional do better than a tracker fund, correct?
Yeah, because
Right, we'll
I
come
know
to
real life examples of people who actually do it through fund managers.
Right. Well, fund managers make a lot of money, but do their customers? Maybe we're going to get a lot of comments from fund managers here. Well, any comments are welcome. So there's a huge difference there, isn't there, in the returns?
There is.
So the cost of fees is crucial to how much overall profit is made, and it is something you can decide on. It's kind of looked at as defense, isn't it? You control how much is paid out. If, however, you want to use a management fund where investments are chosen for you, be aware, again from the FT, not from me, from the Financial Times, only 10% of actively managed funds outperformed the S&P 500 in the last 15 years. Does that answer you?
Yes.
Maybe you're lucky and you can be part of that 10%. But that means 9 out of 10 of your professionals have not beaten the market. And you've only used them because you want to beat the market, because you're greedy. To beat the market, to get a higher return than the market is giving.
Also because you don't want to spend time doing it.
You don't need to with a tracker fund. You just find that tracker fund in India, just direct debit the same amount every month for a number of years, see how much the market gives you, and you'll get the same. Easy, right?
Sounds easy.
It is easy. You've heard of Warren Buffett.
Yes.
Now, I don't want to sound like a salesman for tracker funds. I am not, because I rarely take my own advice. Yeah, it's true. I've never bought a tracker fund. I prefer the adrenaline and fun and arrogance I have of trading my own investments. Why are you laughing? Many people do.
Yes.
Many people have. And I've never had a long-term outlook when it comes to stocks. I don't think I could ever have been in a period where I've put the same amount into an investment for 20 or 30 years.
Have you always been like that?
Yeah, always. My life's just changed too much for me to even think about that. But am I that average salaried employee that goes home to the family and just wants no risk in their lives? But we're not talking about me, are we? I'm not really the salaried employee who wants to invest with minimum risk, but that's why we're doing this podcast. I don't have the discipline to invest the same monthly amount for years and years. Do you?
I think I do.
Have you?
No.
Time to start, Anita, because you don't have 30 years.
No.
No? Do you?
That makes me nervous.
It's already too late for you for 30 years.
Yeah.
25 years maybe.
Yeah.
So what Anita is going to do is research, because does it have to be the Sensex or the Nifty 50 or whatever it's called? Does it have to be India for you?
Not necessarily. Can be anything that's really doing well.
Right, so Anita will announce the results of her research into tracker funds in the Indian stock markets and talk all about how much one has to pay in fees, correct?
Yeah, I'll find out. Thanks.
Right, yes.
I'm looking forward to that homework.
Yes. So I'm about finished there. If you want to go ahead and invest in a professional stock picker, go ahead. And they may well be part of that 10%, and they may well come back to us with other figures and disproving what I've said. I've talked about what happens in the media, follow the media, maybe piggyback what has happened the day before, so hopefully you get a profit. But that's short term. A tracker fund where you put your money away and it grows over a certain number of years, and you don't have to bother yourself with doing research.
Is there any benchmark number that you think is a good number to invest from a salaried person's?
Oh, that's a good question, isn't it? I think they're looking at, of course, it depends on how much they can afford, whether they pay any tax, which we don't here, somewhere between 10 and 20%
of their salary should be
a month.
I
never say should. I'm not going to say should, it's just practical advice.
Yes.
10 to 20% a year. And we have a different system here because Bahrainis have pensions, but expats don't have pensions through their employer.
Yeah.
Because when you have a pension, it's usual that your employer also contributes something, which is all very nice. And we have, anyway, we'll not go down there, but 10 to 20%. Can you do that?
I think it's doable.
When are you going to start? What we could have here is Anita going into a tracker fund and then every year or so, looking at how it's done compared to the market.
Okay.
So you're the guinea pig.
All right.
Right,
Yeah.
right. So breakfast wasn't great today, I have to say.
I'm so sorry, Ron.
Yeah, the milk was all right.
I'm
but
doing intermittent fasting.
it's not quite Ramadan yet, but it might be by the time this is...
This is out,
yes,
probably.
yes. Well, thank you for listening. We will follow this up with property, others which include futures and commodities, and please be here for the guest that we have on cryptocurrency.
So thank you, Ron, for an enlightening session on how to invest in stocks, a follow-up podcast from our previous season. And you can watch this podcast on MH Consultants on YouTube. And please make sure that you also follow us on Instagram for regular updates. We are at mhconsultants_bh. And thank you so much. Thank you, Ron.
Thank you.